Good afternoon, Joint Ops fans. We're going to do a quick YouTube video on some of the frequently asked questions we get anytime anyone ever asks about our program. So this is generally the first question we get asked. Suppose I invest with you. We'll call it $50,000 for this video. Where does the money go? The money will go from the private lender's bank account to the title company. Joint Ops Properties, me and Bob, are never going to touch the investor's dollar. So a quick rundown on how that process works is the money goes from the investor to the title company. The investor is then recorded on the note and the deed of trust with the title company. The investor is also added onto the title and the property insurance as additionally insured. So the reason we do that, if the house burns down, the insurance dollars will not go to Joint Ops. They will go to the holder of the note and the deed of trust. It will go to the investor and returns the capital to the investor. The investor's money then goes to the seller of the property to complete the transaction. How does the investor make money from this investment? The investor makes money monthly on the interest that we pay on the capital invested, in this case $50,000. It's a realized gain month in and month out. Right now, I think this is one of the favorite things that our investors enjoy about this investment is every month interest shows up in their mailbox in the form of a check. We generally pay an 8% annual interest rate, but this is always negotiable. So in this scenario, the investor would receive a monthly check of $333 for the terminal loan. Generally, the terms are 2 years. I think the best way to visualize how the investor makes money is that he or she is the bank in this transaction. Essentially, in this scenario, the investor has cut out the middleman. If you deposit your money in a bank, all the bank is going to do is going to take 10 times that amount of money and then loan it to someone like me and Bob or another REIT or some other real estate investment. The thing I love about these private money loans, and I do loan private money to Joint Ops, the owner of the original capital makes the interest, not the middleman, this time being a bank. What is the best case scenario? Best case scenario is that the investor collects $333 of interest for the terminal loan. The other part of that best case scenario is at the end of the terminal loan, generally 2 years, his or her original capital is returned. Part of this best case scenario is that at the end of the terminal loan, the investor's capital is returned plus the 8% interest they'd made over the last 2 years. The absolute best case scenario is the tenant buyer purchases the house within the 2 years of their lease option. This is the win-win-win that we love with our program. It's a win for the tenant buyer. They are now a homeowner with 2 years of sweat equity in a house. It's a win for the investor. They have gotten their original capital back. They've beat inflation, and they've had an above-market return for 2 years. And then it's been a win for me and Bob. We've collected cash flow, which has compensated us for our risk, and we've paid the investor, and we've made a capital gain on the house. So what happens if this absolute best case scenario does not occur? How do we get the original capital back to the investor at the end of the terminal loan? Usually the most common option we use is we'll go to a bank and show them a cash flowing asset and refinance the private investor loan and then carry a bank loan against it. Other scenarios, we've had a couple investors take a look at our cash flowing properties and we'll refinance the note out with another private investor. The point is that over the course of 2 years, we have several options to return the investor's original capital with interest to them. So what is the worst case scenario with these private money loans? We get asked this all the time, as we should. Worst case scenario is that Joint Ops would default on the loan. We wouldn't pay your interest, and you could then default on the loan. At that point, the investor would receive title to the property and would own the property. Part of the reason we think these investments are such a sound option is that if you invest in a stock or if you invest in a REIT, you don't own all of the asset. So if you were to invest in Kodak and you had stock in that and they went out of business, your piece of paper is worthless. You don't have anything. If you invest in a REIT and they go out of business, you don't know what percentage of that REIT you own. So in the event of a default or a bankruptcy, it would come down to who had the best lawyers to determine who got their original capital back. With our program of one investor, one property, if we default, you know what you own. You own the property you lent on. Once you take the property back, you have two options. You could find a tenant for the property and collect rent, and then collect the cash flow from the property in order to get a return on your investment. The second option is you could sell the house to another investor or wholesaler. So the reason we're adamant about always buying a house at 30 to 50% of retail is so we can protect our investor. When we buy these houses so cheap at 30 to 50%, it protects the investor. In the event of a crash or a default on our part, the investor can then take title of the property, take the property, and sell it to another wholesaler or investor and get the capital back. And for the record, we've completed over 100 of these private loans and are yet to default on any of them. How does joint ops make money? You'll see it in every one of our weekly deals and our weekly videos. Cash flow is king. We are cash flow investors. We make money from the cash flow on these deals. We take the rent, we subtract the taxes, insurance, and the interest that we pay to the investor, and that is the cash flow we are left with. Also, there's office fees and management fees, but we don't need that for this slide. But for us, we are strictly cash flow investors, and we make money through the cash flow. Here's another question we've been starting to get a lot. Why are we always talking about whole life insurance? And we're going to do several videos, because the only downside of talking about whole life this whole time is it's called the infinite banking system, and there's so many infinite ways to profit from it that it's going to require several more videos. But here's the simplest I can break it down. So for our private lenders, when they combine their investment with a whole life insurance, it adds close to a 50% return on their investment after taxes. And we've done a video called How to Maximize Your Real Estate Investment Through Whole Life on our YouTube channel. You can check that out if you're interested. The original reason we got into it was to mitigate our investors' tax liability. The interest that we pay our investors is taxed at ordinary income. If you combine your investment with a whole life policy, the interest you get from the whole life policy pretty much makes you even with whatever taxes you have to pay on this investment. To break those numbers down real quickly, if I pay you 8% interest and you're a high income earner, you're basically going to pay 4 of that 8% to the IRS in ordinary income. If you use a whole life policy to start this investment, you're going to get at least a 4% dividend from the insurance company. So whatever money you're giving to Uncle Sam, you get made whole on in the whole life policy. Plus, that money starts compounding tax-free. And like I said, it's infinite, so there's several other videos we'll be talking about this. We also like it because it puts the control and the flow of the capital in the hands of our investors. Once again, we're going to do lots of other videos on that. Also, if you do listen to our videos, we're huge students, proponents of the Austrian School of Economics. Their insights, it basically helped us start our company. And it also told us why real estate was such a great investment. And using these whole life policies and essentially becoming your own bank is the best way to implement what we've learned from the Austrians. And like I said, we're going to do plenty of other videos on that stuff. I could not answer why we're so high on whole life insurance in one slide. Well, there you have it. Thanks for your time. If you want more information, there's our website. Give me a call, and hope to hear from you soon. Talk to you later. Bye.